Hedging means covering the loss, right? I'm not talking about talking about whether you are making the profit or not. I'm just talking about when you hedge. Hedge means that you are covering the loss. Covering the loss means that you are getting into arrangement where you will be taking a instrument which can reduce or which can try to bring the loss down, right? That is the intention when you get into the hedge. If that is not the intention, that means it is not hedging, right? So these are the 5 items which goes to other comprehensive income. There is also a 6th item as well which goes to other comprehensive income, which is tax related to all of the above. If the tax item is there, if the deferred tax is there, which is related to any of these items here, this tax will also be going to my profit, or this tax will also be going to the other comprehensive income. Hope this is okay with everybody. So there are only 6 items which goes to profit, other comprehensive income: revaluation reserve, change in fair value of some financial assets, actuarial gains and losses, foreign exchange translation reserve, cash flow hedge, and tax related to all of the above. So these are the 6 items which will be going to the other comprehensive income. So we have discussed about the balance sheet, we have discussed about P&L and other comprehensive income. The third thing is cash flow statement. Cash flow statement talks about cash movement, right? What is the cash coming in and going out? It is covered under IAS 7, which is out of syllabus, right? But we know that what cash flow statement is. Number 4. So number 4 is not notes to accounts. Number 4 is actually statement of changes in equity. So what is statement of changes in equity? So we call it statement of changes in equity, SOCE. So change in the promoters fund, exactly, change in the movement in equity. And how do we present it? It is actually nothing but the reconciliation of opening equity to closing equity. What does it mean? It means that if I make a statement, let's assume like this, statement of change in equity, what are the equity items? Equity items would be share capital, share premium, retained earning, all other reserves, or I would say other comprehensive reserves, right? So let's assume I have opening balance of 500 here, 20 here, retained earning 300 here, OCI 50 here. Now the opening balance is given to me. I need to find out what are the changes and how we have arrived to the closing balance. Now what would be the change in the retained earning? Why my retained earning would change from opening to the closing? Why? What could be the kind of change we could have in the retained earning? Profit or loss? Profit for the year, exactly. Profit for the year. Or maybe dividend. Exactly. So profit for the year may increase, whereas dividend would decrease. So I have my closing balance of 310. What would happen to the share capital or share premium? Why my share capital would go up or down? My share capital would go up or down with share issue or buyback. Let's assume we have issued share of 50, whereas the premium also is 50. So my closing balance of share capital and share premium is 550 and 770. Whereas other comprehensive income, again, right? So maybe any other item which is there, for example, let's say revaluation of property or actuarial gains and losses. So all these things would increase my the other comprehensive income closing values. So this is nothing but the reconciliation, how we have arrived from this number we need to have a separate column for each head. Right? We need to have the separate column for each head. Yes. So how we have arrived from the opening balance from this number to the closing balance, which is this number. That is what we see in the statement of changes in equity, which shows that how my promoters value. So this equity actually belongs to the promoters. So how my shareholders value has gone from the opening balance, which is the total of all the opening balances, to the total of all the closing balances. The fifth one, we have notes to accounts. Now what goes under notes to accounts? What is notes to accounts? What all do we include in notes to accounts? So disclosures, accounting policies, other items and everything, right? So if we talk about the flow, what is the flow in the notes to account? The first note is talk about the basis of preparation of financial the first note is that what is the basis of preparation of financial statement. It means that which accounting standard we are following. Are we following IFRS? Are we following Singapore financial reporting standard? Are we following the Australian financial reporting standards? Or we are following US GAAP or Ind AS or whatever it would be. Right? So first note is the basis of financial statement. The second note talks about significant, or I would say the accounting policies of the company. Right? So first note is basis of preparation, second note is the accounting policies, third note means note number 3 onwards, the third items which comes here is all the items of P&L and balance sheet, or I would say details of all the items of P&L and balance sheet. For example, if we have the property, plant and equipment, which is the fixed assets, what is there in the fixed asset get explained in the note number 3 maybe. Then note number 4 could be what is there in the revenue, what is there in the financial asset. All those things would be there in the notes. Number 4 would be for the items which are not there in balance sheet, P&L or cash flows. Can you tell me like which could be the items which are not there in balance sheet, P&L and cash flows but should be there in the notes to accounts? Contingent liabilities. So maybe contingent liabilities, subsequent events, related parties, transactions, segment reporting. All these items would become part of the items which are not there in the balance sheet, P&L or cash flows, but needs to be reported or needs to be explained in the financial statement. The fifth one in the list or in the flow would be all the management judgments. Any judgment or any call management has taken or any estimates management has made, all those management judgments needs to be explained. Now what could be the management judgments here? Management judgments could be related to the life of the asset, right? Could be related to anything which management has taken a call for. Any call management has taken has to be explained in the management judgments note. Sixth is any new accounting standard which is not yet applicable, right? So any new standard come up but yet not applicable. So we need to give the guidance on that what is the impact of that new accounting standard on our existing books or existing items. That's something we also need to explain. And the last one is the capital management, which shows how companies or how management is taking care of companies' fund or companies' capital to maximize shareholders' return. Right? How they are arranging the capital, how they are using the funds. For example, let's say if company needs the fund, whether to go for the equity or whether to go for the loan, how a company is deciding that, how management is deciding that, everything needs to be explained. And why IFRS has been introduced or why IFRS is very, very popular, just because of all these. Why? Because every time when you talk about IFRS, it talks about more and more disclosure. Whatever you have, you should disclose. If you keep on disclosing, it means that you are presenting everything, every item, and the financials are very, very transparent. Right? So one more thing which comes up is risk, right? Which relate to market risk, right? Or any other risk which is there everywhere. Right? So yes, capital management is mandatory note which needs to be taken up. So capital commitment, which will coming up in this only, correct, that in the off balance sheet transactions which are there, items which are not there in the balance sheet, would include this. It would be coming in, right? So it would be coming in the Singapore FRS also, right? So if we see now, right, so you may find out that the requirement is there that how companies are actually managing the capital. May not be a detailed note if company is not taking care of something, but it could be something which would be mentioned there, right, under the capital management thing, right? Or maybe I'll try to find out, then we'll share some relevant example with you, right? So we have talked about the 5 statements which are there: balance sheet, P&L, cash flows, statement of change equity, and notes to account. And apart from that, there is a 6th also, There is a sixth statement also which is not applicable all the time, which is only applicable in some cases. We call it third balance sheet. Yes, Karthik, we'll share that. We call it third balance sheet. Third balance sheet means opening balance sheet of prior period presented. It means if you have, right, so let me just show you that how it will be done. So the third balance sheet is, if we are presenting balance sheet, let's assume for for 2018-19, then you have to present the numbers not just for this year, this is the current year. You have to present the same numbers for the previous year also, which is 2017-18, right? If it is 18-19 current year, 17-18 is the previous year, the third balance sheet would be the opening of the previous year, which is 16-17, right? So the opening of the previous year. The opening of the previous year means that if you are following April to March, so 1st April 18 to 31st March 19 is this date, 1st April 17 to 31st March 18 is this date, and this would be 1st April 16, which is the opening of the previous year, 1st April 17, which is the opening of the previous year, right? This is the third balance sheet which we prepare. But when it is to be prepared, we'll be discussing that in one standard, which is IAS 8, which gives the guidance on when it is to be prepared. It is only prepared when we have three scenarios, or in fact two scenarios. When you change your accounting policy for any item. For example, you have changed the accounting policy for any item. Then in that case, you need to show the balance sheet for this year, last year, as well as the opening of the last year. Right? When you change your accounting policy for any item. For example, let's say you were following FIFO method for inventory valuation. You changed to weighted average. Now this is change in accounting policy. When you change the accounting policy, you need to go back and prepare one more balance sheet. The full balance sheet. Full balance sheet means the third balance sheet for the full period. Right? Accounting policy could be changed for the new accounting standard or the first time adoption also. Why in first time adoption? Why in first time adoption of IFRS or any other new standards we prepare the third balance sheet? Why? The reason is, what is first time adoption? We are changing the accounting policies. Because in the first time adoption, what you are doing? You are changing your accounting policies from the older GAAP to the new GAAP, and this is as per IAS 8, where you need to present your numbers for the three balance sheets. Right? So just because the change in accounting policy requires you to make the new account, the third balance sheet there, right? The second point is when you have prior period item, or I can say previous year's error. For example, let's say you are preparing financials for 18-19 and you have prepared the previous year would be 17-18. Let's assume you have made an error in year 2013-14. Now to correct that error, you cannot correct that error in the current year. To correct that error, you need to now open a third balance sheet, which is 1st April 17, and the error would be corrected in the third balance sheet, not in the current year. That is the requirement as per IAS 8. So basically the sixth item which we talked about, the third balance sheet would only be prepared when two things are there, when you are moving from one accounting standard, or when you are changing the accounting standard, when you are changing the accounting policy, any accounting policy, or when you have prior period item, which is the previous year errors. If that is the case, then in that case, you need to find out, or you need to prepare the third balance sheet. The normal course of business, right? So can you tell me that normal course of business? What do you mean by normal course of business? For example, let's say I am doing XYZ business. Now I changed my business from XYZ to another business, right? It is not the change in accounting policy. It is change in the business. That change in the business would have the impact on the numbers, but would not require me to change in depreciation policy. We will be discussing whether change in depreciation policy is the change in accounting policy or something else, right? Any change in policy, right? Any change in accounting policy would have the impact on, right? As I mentioned that I was moving away from FIFO to weighted average. When I have taken step from FIFO to weighted average, it is just only one accounting standard which get impacted, and that one impact is asking me to take the hit on the entire balance sheet. Now if I just show you that these are the 6 items which we have discussed. So first thing is balance sheet, second is profit and loss account and other comprehensive income, third is statement of change in equity, fourth is cash flow statement, fifth is notes to accounts with significant with accounting policies as well as explanatory information, and the sixth one is the extra balance sheet, right? Now apart from all these, annual report of the company will always have different or the other information also, right? If you pick the annual report of some listed companies, you may find that they are giving the environmental report, talking about that what impact they are putting on the environment or what they are doing for the environment, or sustainable reporting. Is there any value added statement that how they have how the company is growing and what is happening in the business, or any review from management that what steps management is taking to make the business better. All these information which are mentioned, which companies present, on all these information IFRS is not applicable. IFRS is applicable only for these 6 items. Rest of the other items IFRS is not applicable to, right? So we are not going to apply IFRS on any of these items.